Here's the truth most people don't know about one of the greatest investors of all time. Peter Lynch didn't start on Wall Street. He started as a caddy at a golf course. Imagine that. A teenage kid carrying golf bags at a country club, listening, watching, learning how wealthy businessmen talk about money, companies, and risk. That was his first classroom. Not Harvard, not some elite trading floor. Real conversations, real businesses, real curiosity. And that curiosity changed his life. In Chapter 1 of One Up on Wall Street, Lynch tells us how he became a stock picker, and it's not the story you'd expect. He didn't grow up dreaming about candlestick charts or earnings models. He simply wanted to understand how businesses work. While caddying, he noticed something powerful. The men who ran companies thought differently. They weren't gambling, they were analyzing. They were evaluating probabilities. They were thinking long-term. That mindset stuck with him. Years later, when Lynch managed the Fidelity Magellan Fund, he averaged nearly 29% annually. Let that sink in. 29% per year. He turned Magellan into one of the best-performing mutual funds in history. But here's the key point. He didn't do it with complicated formulas. He did it by observing the world around him. Lynch believed everyday people have an edge. Yes, an edge over professional investors. Why? Because we experience products before Wall Street notices them. Think about this. Imagine you walk into a shopping mall and every single store is empty except one. That store is packed, lines out the door, customers buying armfuls of products. You go back next week, still packed. A month later, still packed. Most people would say, "Wow, that store is popular." Lynch would say, "I wonder if it's publicly traded." That's exactly how he found Dunkin' Donuts. He saw the crowds. He tasted the product. He understood the demand. He didn't need a PhD in finance. He needed observation and common sense. And this is the core lesson of Chapter 1. Investing isn't about predicting the economy. It's about paying attention. Too many people think the stock market is reserved for geniuses. They believe you need insider knowledge, advanced math, or a Bloomberg terminal. Lynch disagrees. He says your daily life is full of investment clues, grocery stores, restaurants, tech products your kids love, brands dominating conversations. Your advantage is proximity. Wall Street analysts sit in offices staring at spreadsheets. You are out in the real world. You see trends forming before earnings reports confirm them. You notice when a product goes from niche to mainstream. But here's the catch. Curiosity is required. Lynch didn't just notice businesses. He asked questions. Why are customers loyal? Is this company expanding? Are earnings growing? Is this a fad or a long-term shift? That's the difference between gambling and investing. So here's your takeaway. First, start where you are. Look at the companies you already interact with. Second, stay curious. Ask why something is working. Third, remember that great investing often starts with simple observations. Peter Lynch's journey didn't begin with millions of dollars. It began with attention. And maybe that's the most empowering idea in this entire book. You don't need to beat Wall Street at their game. You just need to notice what they haven't noticed yet. Let me ask you something. When you hear the phrase professional investor, what do you picture? A sharp suit, multiple screens, Bloomberg terminals flashing, Ivy League degrees framed on the wall. Now here's the uncomfortable question Peter Lynch raises in Chapter 2. Does professional automatically mean better? Lynch calls Wall Street full of oxymorons, phrases that sound impressive but don't always make sense. Professional investor is one of them. Because here's the reality. Professionals have constraints, and those constraints are your opportunity. Think about a mutual fund manager running $10 billion. If they find a small company worth $300 million, even if it doubles, it barely moves their portfolio. It's too small to matter, so they ignore it. But if you have a $50,000 portfolio, a small stock doubling could meaningfully change your net worth. That's the hidden advantage of being small. Professionals also face pressure you don't see. They answer to clients. They answer to quarterly performance reports. If they underperform for a year or two, they lose their job. So what do? They play it safe. They hug the index. They buy what everyone else is buying. Because getting fired for being different hurts more than underperforming with the crowd. But you don't have that pressure. You don't have to explain to anyone why your stock is down this quarter. You don't have to produce monthly reports. You don't have to follow the herd to protect your reputation. That freedom is powerful. Lynch makes it clear, individual investors can outperform professionals, not because they're smarter, but because they're more flexible. Let's make this practical. Imagine a new fast casual restaurant opens in your neighborhood. You try it. It's incredible. Every time you drive by, the parking lot is full. Your friends are talking about it. The company plans to open to 100 more locations. A fund manager might not even look at it yet. It's too small, too early. But you can. And here's another edge. Professionals often overcomplicate things. They build complex models. They rely on forecasts stacked on forecasts. But Lynch's philosophy is simpler. Understand the business. Understand the growth. Check the balance sheet, then decide. You don't need 50 variables. You need clarity. Now let's talk psychology. Wall Street operates on consensus. If every analyst rates a stock a buy, it feels safe. But safe doesn't mean profitable. In fact, by the time everyone agrees something is great, the opportunity is often gone. Individual investors can act before consensus forms. And here's the deeper insight. Institutions move slowly. They need committee approval. They need compliance checks. They need liquidity. You can make a decision tonight. That speed matters. But there's a warning here too. Having an edge doesn't mean automatic success. If you chase hype, follow social media trends, or buy stocks you don't understand, you lose your advantage. The edge only works if you combine flexibility with discipline. So what's the real lesson of Chapter 2? First, stop assuming Wall Street knows more than you. Second, recognize your size is a strength, not a weakness. Third, use your freedom wisely. Focus on businesses you understand and can hold long term. Peter Lynch didn't believe in blind trust in professionals. He believed in informed independence. Because sometimes, the best investor in the room isn't the one in the suit. It's the one paying attention, thinking independently, and willing to move before the crowd. Is the stock market just a casino with better lighting? That's the question Peter Lynch tackles in Chapter 3. Is this gambling, or what? Because let's be honest, to most people, investing feels like rolling dice. Prices go up, prices go down. Headlines scream panic. Friends brag about hot tips. It looks random. It feels random. But Lynch makes a bold distinction. Speculation is gambling. Investing is ownership. And those are two completely different mindsets. Here's the shift. When you buy a stock, you're not buying a blinking ticker symbol. You're buying a piece of a real business, a company with employees, products, revenue, costs, and profits. Let's make it simple. If you bought a local coffee shop in your neighborhood, would you panic if someone offered you 20% less for it tomorrow? Probably not. You'd look at the sales. Are customers still coming in? Are revenues stable? Are profits growing? You'd evaluate the business. But in the stock market, people do the opposite. The price drops 20%, and suddenly they think the world is ending. That's not investing. That's emotional speculation. Lynch argues that the confusion happens because most people focus on price movements instead of business performance. They treat stocks like lottery tickets instead of ownership stakes. Here's a real-world example. Imagine two investors buy shares of the same company. Investor A checks the stock price 5 times a day. Investor B checks quarterly earnings reports. 6 months later, the stock is volatile, up 15%, down 10%, up again. Investor A is stressed, anxious, reacting to every swing. Investor B is calm. Revenue is growing. Margins are improving. Expansion is on track. The business is stronger than ever. Who's gambling? The market will always fluctuate. That's its nature. But business fundamentals move much slower and tell a clearer story. Lynch emphasizes something powerful. Over the long term, stock prices follow earnings. Not headlines, not rumors, not predictions, earnings. If a company consistently grows profits year after year, eventually the stock reflects that reality. But gamblers don't wait for earnings. They chase momentum. They buy because it's going up. They sell because it's going down. They operate on noise. Investors operate on evidence. And here's where discipline matters. Before you buy any stock, Ask yourself, would I be comfortable owning this business if the stock market closed for 5 years? If that question makes you uncomfortable, you might be speculating. Now, this doesn't mean investing is risk-free. Businesses fail, markets crash, mistakes happen. But the risk is calculated when it's based on understanding. Lynch didn't build one of the best track records in history by predicting short-term movements. He studied companies. He evaluated growth. He separated temporary volatility from permanent problems. So what's the practical takeaway? First, stop staring at daily price changes. Second, start analyzing businesses, revenue growth, profits, competitive advantage. Third, adopt the owner mindset. You are buying part of a company, not placing a bet. Because the stock market only looks like a casino when you treat it like one. When you shift your focus from price to performance, from speculation to ownership, everything changes. Investing isn't gambling, it's business. And the sooner you see stocks as businesses, not bets, the sooner you start playing a completely different game. Before you buy any stock, Peter Lynch says you need to do something simple and slightly uncomfortable. Look in the mirror. Chapter 4 is called Passing the Mirror Test, and it's not about analyzing balance sheets. It's about analyzing yourself. Because here's the truth. The biggest risk in investing isn't the market. It's you. Lynch argues that before you invest in any company, you need to understand your own personality, your own goals, and your own tolerance for volatility. Too many people jump into stocks without asking a basic question. What kind of investor am I? Let's break this down. Imagine you buy a fast-growing tech stock. It's expanding aggressively, reinvesting profits, moving into new markets. Huge potential, but it's volatile. In 6 months, it drops 30%. Can you handle that? If a 30% drop keeps you up at night, checking your phone at 2 a.m., refreshing your brokerage app, then maybe high-growth stocks aren't for you. That doesn't make you bad at investing. It just means your temperament doesn't match the strategy. And temperament matters more than intelligence. Lynch makes it clear. Investing success depends on aligning your investments with your emotional strength. If you panic and sell during normal volatility, you'll sabotage even the best strategy. Now think about the opposite scenario. Maybe you're extremely patient. You don't need quick wins. You're comfortable holding a stock for 5 or 10 years while the business compounds. In that case, you might thrive owning steady compounders or undervalued companies waiting for recognition. The key is self-awareness. Here's a practical example. Two investors buy the same stock at $50. The business fundamentals are solid, earnings are growing, but the market enters a downturn and the stock drops to $35. Investor A sells out of fear, locks in a loss. Investor B reviews the earnings report. Nothing has changed. In fact, the company gained market share. Investor B buys more. 5 years later, the stock is at $120. Same stock, different psychology, different outcome. Lynch's point is simple but powerful. If you don't understand your own behavior, the market will expose it. He also emphasizes another part of the mirror test, your financial situation. Are you investing money you might need next year? If so, you're setting yourself up for emotional decisions. Stocks are for long-term capital. If you need the money for rent, tuition, or a house down payment in the near future, volatility becomes dangerous. So before analyzing P/E ratios or growth rates, ask yourself, how long can I realistically hold this investment? How much volatility can I tolerate? Will I panic if headlines turn negative? Because the market will test you. It always does. Passing the mirror test means building a strategy you can stick with through crashes, corrections, and noise. It means choosing investments that match your time horizon and emotional resilience. And here's the deeper lesson. Investing isn't about finding the perfect stock. It's about becoming the right investor. You can't control the economy. You can't control interest rates. You can't control short-term market swings. But you can control your behavior. Peter Lynch understood that discipline beats brilliance. Self-awareness beats prediction. So before your next investment, pause. Look in the mirror. Because the most important analysis you'll ever do isn't of a company. It's of yourself. Let me ask you one of the most common questions in investing. Is this a good time to get into the market? Peter Lynch's answer in Chapter 5 is simple and brutally honest. Please don't ask, because the moment you base your decision on whether the market feels good or bad, you've already shifted your focus away from what actually matters. Most people are obsessed with timing. They wait for the perfect entry point. They watch the news. They analyze interest rates. They try to predict recessions. They tell themselves, I'll invest when things feel more stable. But here's the reality. Things never feel stable. When the market is high, people say it's too expensive. When the market crashes, people say it's too dangerous. When it's flat, people say it's uncertain. There's always a reason not to invest. Lynch makes a powerful point. More money has been lost preparing for corrections than in the corrections themselves. Think about that. Imagine someone pulled their money out of the market because they were afraid of a recession. They sit in cash for 2 years waiting for the right moment. Meanwhile, the market quietly rises 30%. They didn't lose money in a crash. They lost money waiting. The problem with market timing is that it requires perfect decisions, when to get out and when to get back in. Missing just a handful of the best performing days in the market can dramatically reduce long-term returns. And here's the twist. Those best days often happen during the most volatile periods, when fear is high, when headlines are negative. In other words, the moment that feels the worst emotionally is often financially critical. Lynch's philosophy shifts the question entirely. Instead of asking, is this a good market? Ask, is this a good company? Because even in terrible markets, great companies grow. Even during recessions, strong businesses gain market share, improve efficiency, and position themselves for the recovery. Let's make it practical. Imagine it's 2008, the financial crisis, fear everywhere, stocks collapsing. If you asked, is this a good market? The answer emotionally would be no. But if you asked, is this a strong company with solid cash flow and long-term growth potential? You might have found incredible opportunities. And those who invested in strong companies during that period saw massive returns in the following decade. The market's mood is temporary. Business performance compounds. Now, this doesn't mean you ignore valuation or economic conditions entirely. It means you don't let macro predictions dominate your decision-making. Lynch didn't try to forecast interest rates. He studied earnings growth, balance sheets, and competitive advantages. Because over time, earnings drive stock prices. So here's the actionable takeaway. First, stop trying to predict the market's direction next month. Second, focus on identifying businesses that can grow for years. Third, commit to a long-term horizon, because volatility is normal, but compounding is powerful. The stock market will always feel uncertain. That uncertainty is permanent. But disciplined investors don't wait for perfect clarity. They invest in strong businesses, and they stay invested. So the next time someone asks you, is this a good market? You'll know the better question to ask. What if I told you that you don't need 20 great stocks to become wealthy? You might just need one. In Chapter 6, Peter Lynch introduces one of the most powerful ideas in investing, the tenbagger. A tenbagger is a stock that increases 10 times in value. You invest $10,000, it turns into $100. Zero. One decision can completely transform your financial future. And here's the crazy part. You don't need to find them often. Lynch built his legendary track record not by being right every time, but by finding a few massive winners that carried the entire portfolio. Think about Home Depot in its early days. After its IPO in 1981, the stock increased roughly 20-fold in less than 2 years. Then it climbed another 10 times over the next several years. Investors who recognized the business model early, big box home improvement, warehouse pricing, massive selection, experienced life-changing returns. But here's what's important. Those gains didn't look obvious at the beginning. At first, it was just a company opening large stores for contractors and DIY homeowners. Nothing flashy, no hype, no viral headlines. That's how tenbaggers often start. Lynch explains that big winners usually come from strong, expanding businesses, not from turnaround stories or speculative bets. They often have simple models, scalable operations, and long growth runways. So how do you stock a tenbagger? First, you pay attention to growth. Is the company expanding locations? Increasing earnings consistently, gaining market share. Second, you evaluate the size of the opportunity. A company operating in a massive market has room to grow for years. A small niche with limited demand caps upside. Third, and this is critical, you hold on. Most investors sabotage their own tenbaggers. The stock doubles, and they sell. It triples, and they sell. They lock in small gains while the real compounding hasn't even started. Lynch emphasizes that you must let your winners run. Here's a practical example. Imagine you buy a stock at $20. It rises to $40. You feel smart. You're tempted to take profits. But earnings are still growing at 25% annually. New stores are opening. Debt is manageable. Nothing fundamental has changed. Selling at $40 might feel safe, but the real opportunity could be at $200 over the next decade. The math of investing is asymmetric. Your downside in a stock is 100%, but your upside, theoretically unlimited. One 10-bagger can offset several small mistakes. But let's be clear, this doesn't mean blindly holding everything. You must continuously check the story. Is growth slowing permanently? Is debt rising dangerously? Has competition eroded the advantage? If the story changes, you reassess. If the story remains intact, patience becomes your edge. And here's the deeper psychological challenge. 10-baggers rarely move in straight lines. They drop 20%. Sometimes 30%. Volatility shakes out weak hands. Only conviction, based on fundamentals, keeps you invested. So what's the lesson from Chapter 6? First, understand that one big winner can change everything. Second, focus on companies with real, scalable growth. Third, have the discipline to hold while the thesis remains strong. You don't need to predict the economy. You don't need dozens of perfect picks. You need a few exceptional businesses and the courage to stick with them long enough for compounding to work its magic. That's how fortunes are built. One 10-bagger at a time. You found a stock that looks incredible. Your friend is excited about it. The headlines are bullish. The chart looks strong. You feel that rush, that sense of this is it. And Peter Lynch asks a simple question in Chapter 7. Okay, you've got it, but what is it? This chapter is about clarity, because enthusiasm without understanding is dangerous. Lynch believed that if you can't explain in simple language what a company does and why it will grow, you shouldn't own the stock, period. Not a complicated explanation, not industry jargon, not buzzwords. Simple. Imagine you're explaining the company to a 12-year-old. What does it sell? Who buys it? Why do customers choose it? How does it make money? If you can't answer those questions clearly, you're not investing, you're guessing. Let's make this real. Suppose someone tells you about a revolutionary AI-powered, blockchain-integrated, cloud-native data optimization platform. Sounds impressive, right? But when you ask how it makes money, the answer gets fuzzy. When you ask who the paying customers are, it's unclear. When you ask whether profits are growing, you hear, well, they're investing for growth. That's not a thesis, that's a slogan. Now compare that to something simple. This company sells home improvement supplies at warehouse prices. It's expanding into new cities. Revenue has grown 20% annually for 5 years. It has manageable debt and strong cash flow. Clear, concrete, understandable. Lynch wasn't against complex businesses. He was against blind ownership. Here's the deeper insight. Complexity often hides risk. When you don't understand how a company makes money, you can't recognize when something goes wrong. You won't know if declining margins are temporary or structural. You won't know if competition is increasing. You won't know if management is over-promising. Understanding creates conviction. And conviction matters because volatility is inevitable. Let's say you buy a stock you barely understand. 2 months later, it drops 25%. What do? You panic. Now imagine you deeply understand the business model. You know how it earns revenue. You've read the financials. You believe in the long-term demand. The same 25% drop feels very different. Instead of fear, you evaluate. Has the story changed? Are earnings still growing? Is the competitive position intact? Clarity reduces emotional decision-making. Lynch also encourages writing down your investment thesis before you buy. Just a few sentences. What does the company do? Why will it grow? What could go wrong? If you can't write that clearly, you're not ready. This discipline protects you from hype cycles and narrative bubbles. It forces you to separate excitement from analysis. And here's the practical takeaway from Chapter 7. First, only invest in businesses you can explain simply. Second, avoid jargon-driven stories without clear profit paths. Third, write down your reasons before you buy and revisit them later. Because in the stock market, confidence built on ignorance collapses fast. But confidence built on understanding, that's durable. You don't need to understand every industry in the world. You just need to understand the ones you invest in. So the next time you think, I've got it, pause. Ask yourself one more question. What is it really? What does the perfect stock look like? Most people imagine something exciting, cutting-edge technology, media hype, a charismatic CEO on magazine covers, a stock everyone is talking about. Peter Lynch says that's usually the wrong answer. In Chapter 8, he explains that the perfect stock often looks boring, almost forgettable. The kind of company that doesn't make headlines. The kind of business your friends wouldn't brag about at a party. And that's exactly why it can be so profitable. Lynch loved companies with dull names in dull industries. Businesses that did something simple, necessary and repeatable: waste management, auto parts, food distribution, basic retail chains. Why? Because boring businesses attract less attention, and less attention often means lower valuations. Wall Street loves excitement. Analysts chase the next big trend. Media amplifies hot sectors. Money floods into whatever sounds revolutionary. But real wealth is often built quietly. Let's imagine two companies. Company A is a flashy electric vehicle startup. It's constantly in the news. The CEO is on social media every day. The stock is volatile. The story is huge. Company B manufactures industrial cleaning supplies. No headlines, no hype. But revenue grows 12% every year. Cash flow is steady. Debt is manageable. It steadily expands into new regions. Which one is more likely to quietly compound over a decade? Lynch would argue, don't underestimate Company B. The perfect stock, according to Lynch, has a few characteristics. First, it has a simple, understandable business model. If you can explain how it makes money in 1 or 2 sentences, that's a good sign. Second, it has room to grow. Maybe it's expanding into new states. Maybe it's opening new locations. Maybe it's gaining market share in a fragmented industry. Third, it's not overly followed by analysts. The fewer institutions paying attention, the greater the chance it's undervalued. Fourth, it has strong financials, reasonable debt, growing earnings, and solid cash flow. Here's a real-world mindset shift. If a company sounds boring, ask yourself, is the product essential? Is demand recurring? Do customers need it regardless of economic cycles? Sometimes the most predictable businesses are the most powerful long-term. And here's another insight. Exciting stories create high expectations. High expectations are dangerous. If a company is priced for perfection, even slightly disappointing results can crush the stock. But when expectations are low, steady execution can surprise the market. The perfect stock doesn't need perfection. It needs consistency. Lynch also points out something subtle. Companies with unglamorous images often face less competition. When an industry isn't trendy, fewer entrepreneurs rush in. That stability can protect margins. So what's the actionable takeaway from Chapter 8? First, don't chase glamour. Excitement is not a strategy. Second, look for simple businesses with consistent growth. Third, pay attention to valuation. Boring companies often trade at reasonable prices. Fourth, remember that steady compounding beats dramatic speculation. The stock market rewards patience more than excitement. You don't need a company that changes the world overnight. You need a company that quietly improves earnings year after year. Because over time, boring can become beautiful. And the perfect stock might be hiding in the most ordinary place. Some stocks look exciting. They come with dramatic headlines, bold turnaround stories, charismatic CEOs promising a comeback. The price has already fallen 70%, and someone says, it can't go any lower. That's exactly where Peter Lynch raises a red flag in Chapter 9, Stocks I'd Avoid. Because not all opportunities are opportunities. One of the biggest traps in investing is the turnaround story. A struggling company claims it's about to reinvent itself. New management, new strategy, new vision. It sounds hopeful, but hope is not an investment strategy. Lynch warns that turnarounds rarely turn when a company is drowning in debt, losing market share, and burning cash. The odds are not in your favor. Yes, some recover, but many quietly disappear. Here's the psychology behind it. Investors love buying something that has fallen. It feels like a bargain. If a stock drops from $100 to $20, people think they're getting an 80% discount. But a lower price doesn't mean lower risk. If the business model is broken, $20 can still go to $5 or to zero. Now compare that to a strong company temporarily down because of market volatility. Earnings are stable, debt is manageable, customers are loyal. That's different. Lynch draws a clear line between temporary setbacks and structural decline. Let's take a practical example. Imagine a retail chain that hasn't adapted to e-commerce. Sales are falling year after year. Stores are closing. Debt is rising. Management announces a transformation plan. Investors jump in thinking, if it just returns to its old glory, I'll triple my money. But what if consumer behavior has permanently shifted? What if competitors are too strong? What if the brand has lost relevance? That's not a dip, that's decay. Another type of stock Lynch avoids is the hottest industry stock. When an industry becomes trendy, whether it's biotech, .com, crypto, AI, or anything else, capital floods in, valuations skyrocket, expectations become unrealistic. The problem isn't the industry itself, it's the price you pay. If growth expectations are extreme, even strong performance may disappoint investors. High expectations create fragile stocks. Lynch also warns against companies that diversify to far outside their expertise. When management suddenly jumps into unrelated businesses, it can signal desperation or poor capital allocation. Stick to what you understand and watch when companies don't. So what's the practical takeaway from Chapter 9? First, be skeptical of turnaround stories fueled by hope instead of evidence. Second, don't confuse a falling price with a bargain. Third, avoid excessive debt. It kills companies during downturns. Fourth, be cautious when hype drives valuation beyond fundamentals. The market rewards growth and strength over time. It rarely rewards weakness and wishful thinking. Remember, you don't have to swing at every pitch. Sometimes the smartest move in investing isn't buying the next big thing. It's avoiding the next big mistake. Because protecting your capital is just as important as growing it. And often, the difference between long-term success and frustration is simply knowing which stocks to walk away from. In the short term, stocks move on stories. In the long term, they move on one thing: earnings. That's the core message of Chapter 10, earnings, earnings, earnings. And Peter Lynch doesn't repeat the word 3 times by accident. Because if you strip away the headlines, the hype, the analyst upgrades, and the market noise, what ultimately drives stock prices over time is profit growth. Let's make this simple. A stock is not just a symbol on your screen. It represents a business. And a business that consistently increases its earnings becomes more valuable. Period. You can have the best marketing in the world, the most exciting CEO, the hottest industry. But if earnings don't grow, eventually the stock reflects that reality. Here's how Lynch wants you to think. Imagine you own a small private company. Every year, profits increase by 15%. Would the value of your business rise over time? Of course it would. Public companies are no different. Now here's where investors go wrong. They fall in love with narratives. This company is disrupting the industry. This is the future. Everyone is talking about it. But when you open the financial statements, earnings are flat, or worse, declining. That's a warning sign. Lynch emphasizes that earnings growth is the engine behind tenbaggers. When profits compound year after year, stock prices eventually follow. Not immediately, not smoothly, but inevitably. Let's talk about a practical metric, the P/E ratio, price to earnings. The P/E tells you how much investors are paying for each dollar of earnings. But that number only makes sense when you compare it to growth. If a company has a P/E of 30, but is growing earnings at 30% per year, that might be reasonable. If it's growing at 5%, that same PE is expensive. This is where Lynch introduces the idea behind the PEG ratio, comparing PE to growth rate. A PEG around 1 often signals a fair valuation for a growth company. The point isn't to memorize formulas. The point is to connect price with performance. Here's a powerful example. Two companies trade at $100 per share. Company A earns $5 per share and grows earnings 20% annually. Company B earns $5 per share, but growth is flat. 5 years later, Company A's earnings have nearly doubled. Company B's earnings haven't moved. Which stock do you think performs better over time? Earnings growth creates intrinsic value. Now, Lynch also warns against short-term earnings noise. A single bad quarter doesn't always mean a broken company. Look for trends, multi-year growth patterns, consistency, and be careful with adjusted earnings that ignore real costs. Cash flow matters. Real profits matter. Here's the actionable takeaway from Chapter 10. First, focus on companies with consistent earnings growth. Second, evaluate valuation relative to that growth. Third, ignore short-term price swings and watch long-term profit trends. Fourth, remember that eventually, fundamentals win. The market can misprice a stock for months, even years, but it cannot ignore earnings forever. If you want to simplify investing down to one principle, this is it. Find businesses that grow profits steadily and don't overpay for them. Because in the end, behind every great stock chart is a company quietly increasing its earnings. And that's where real wealth begins. If you had just 2 minutes to explain why you own a stock, could you do it? Not 10 minutes, not a complicated spreadsheet. 2 minutes. That's the focus of Chapter 11, the 2-minute drill. And this might be one of the most practical disciplines Peter Lynch teaches in the entire book. Here's the idea. Before you buy a stock, you should be able to clearly and confidently explain, in under 2 minutes, exactly why you're investing in it. What does the company do? Why is it growing? Why is it undervalued or attractive today? What has to happen for you to make money? If you can't answer those questions quickly and clearly, you probably don't understand the investment well enough. And if you don't understand it, volatility will destroy your confidence. Let's walk through a simple example. Instead of saying, "This is a next-generation cloud-based infrastructure platform leveraging AI-driven analytics for scalable enterprise optimization," try this. This company provides cloud software to small businesses. Revenue has grown 25% annually for 5 years. It's expanding internationally, and profits are increasing. The stock trades at a reasonable valuation compared to its growth. That's clear, concrete, logical. The 2-minute drill forces simplicity, and simplicity builds conviction. Lynch believed that writing down your thesis protects you from emotional decisions later. Because when the stock drops 15%, you don't rely on feelings. You revisit your reasoning. Has revenue slowed? Has debt increased? Has competition damaged margins? If the original thesis still holds, the price movement is just noise. But here's what most investors do instead. They buy based on excitement, momentum, social media, a headline. Then when the stock dips, they can't articulate why they bought it in the first place. No clarity means no conviction. No conviction means panic. The 2-minute drill also protects you from buying stocks that sound impressive but lack substance. If your explanation depends on buzzwords instead of numbers, that's a warning sign. Lynch often categorized stocks before buying them: slow growers, stalwarts, fast growers, cyclicals, asset plays, turnarounds. Each category had different expectations. A fast grower should show strong earnings expansion. A cyclical will fluctuate with the economy. Your 2-minute explanation should match the category. For example, this is a fast-growing regional retailer expanding store count by 15% per year. Earnings are compounding at 20%. Debt is low. If expansion continues, profits should double in 4 years. Now you have measurable expectations. And here's something powerful. The 2-minute drill isn't just for buying. It's for holding. Every few months, revisit your thesis. Can you still explain it clearly? Has anything changed? If the story breaks, you reassess. If the story remains intact, you stay patient. Here's the actionable takeaway from Chapter 11. First, write your investment thesis before buying. Second, keep it simple, no jargon, no fluff. Third, identify what must go right for the investment to succeed. Fourth, revisit your explanation regularly. Because in the market, clarity is confidence. And when volatility hits, and it will, the investors who survive aren't the ones with the most complex models. They're the ones who can calmly say, in 2 minutes or less, I know exactly why I own this. Most investors say they've done research. But what does that actually mean? Did they scroll through a few headlines, watch a 10-minute YouTube video, read a tweet thread? In Chapter 12, Getting the Facts, Peter Lynch makes one thing clear. Real investing requires real homework. And the good news, the homework isn't complicated. It just requires effort. Lynch wasn't sitting in a secret room with insider information. He was reading annual reports, studying earnings statements, listening to conference calls, visiting stores, talking to management when possible. He was gathering facts, not opinions. Here's the difference. Opinions are everywhere. Facts are buried in financial statements. If you want conviction, you need facts. Let's say you're considering buying shares of a retail company. The story sounds great. Expanding locations, strong brand, loyal customers. But before you invest, you open the annual report. You look at revenue growth over the past 5 years. Is it consistent? You check earnings per share. Are profits growing or shrinking? You examine debt levels. Can the company comfortably service its obligations? You analyze cash flow. Is the business actually generating cash, or just reporting accounting profits? These aren't advanced Wall Street tricks. They're basic fundamentals. Lynch emphasizes that numbers tell a story. Revenue shows demand. Margins show efficiency. Debt shows risk. Cash flow shows reality. And here's something powerful. When you understand the numbers, fear decreases. Imagine a stock you own drops 20%. The media says the sector is under pressure. Social media is negative. But you've done your research. You know the company's balance sheet is strong. You know earnings are still growing. You know expansion plans are on track. That knowledge creates stability. Without facts, you're reacting to noise. With facts, you're evaluating evidence. Lynch also encourages investors to go beyond spreadsheets. If it's a retail company, visit the store. If it's a restaurant chain, eat there. If it's a product company, use the product. Observe customer traffic, product quality, pricing power, competitive positioning. Wall Street analysts may be thousands of miles away. You are in the real world. But observation must connect back to numbers. A busy store is great, but is it profitable? Growth without profits can hide problems. Another key point in this chapter is avoiding over-reliance on forecasts. Analysts often predict earnings years into the future. Lynch preferred looking at current performance and realistic growth trends. Focus on what is happening, not what someone hopes will happen. Here's the actionable takeaway from Chapter 12. First, read the annual report, especially the income statement, balance sheet, and cash flow statement. Second, look for consistent revenue and earnings growth. Third, check debt levels carefully. High debt increases risk dramatically. Fourth, combine financial analysis with real-world observation. Fifth, base decisions on evidence, not excitement. Research doesn't guarantee success, but lack of research almost guarantees mistakes. In the stock market, confidence doesn't come from hype. It comes from understanding. When you know the facts, volatility becomes less intimidating. Headlines lose their power. Short-term swings feel smaller because you're not guessing anymore. You're investing with information, and that's a completely different game. You don't need 50 financial ratios to become a great investor. You need a few, and you need to understand what they're telling you. In Chapter 13, Some Famous Numbers, Peter Lynch cuts through the noise. Because Wall Street loves complexity, they throw around acronyms, advanced metrics, and technical language that makes investing sound like rocket science. Lynch disagrees. He believed a handful of key numbers could tell you almost everything you need to know about a company. Let's start with the most famous one, the P/E ratio, price to earnings. The P/E tells you how much investors are willing to pay for $1 of a company's earnings. If a stock trades at $40 and earns $2 per share, its P/E is 20. But here's the mistake people make. They look at the P/E in isolation. A P/E of 20 is meaningless without context. Is the company growing earnings at 5% a year? That might be expensive. Is it growing at 25% a year? That might be reasonable. This is where Lynch introduces a powerful concept, comparing P/E to growth rate, what later became widely known as the PEG ratio. If a company's P/E roughly matches its growth rate, it may be fairly valued. A company growing at 20% annually with a P/E around 20, that's interesting. If it's growing at 20% but trading at a P/E of 50, now you're paying a premium. Growth must justify price. Next, Lynch emphasizes earnings growth consistency. Not one great year, not one lucky quarter, multi-year, steady growth. Compounding only works when growth persists. Then there's debt. Debt can amplify returns during good times, but it destroys companies during bad times. Lynch paid close attention to the debt-to-equity ratio and overall balance sheet strength. A company overloaded with debt has less flexibility. Rising interest rates, economic downturns, or slowing sales can quickly turn manageable debt into a crisis. Strong balance sheets create resilience. Another number Lynch respected, cash flow. Reported earnings can sometimes be adjusted or influenced by accounting choices. Cash flow is harder to manipulate. If a company shows profits but generates little real cash, that's a warning sign. Cash keeps businesses alive. Now here's the key mindset shift. These numbers are not predictions, they're indicators. They help you evaluate whether a company is healthy, growing, and reasonably priced. They reduce uncertainty. They replace storytelling with structure. Let's put it all together with a simple example. Imagine a company trading at a P/E of 18. Earnings have grown 18% annually for 5 years. Debt is low. Cash flow is strong. Expansion plans are realistic. That's a business worth serious attention. Now imagine another company with a P/E of 60. Earnings growth is inconsistent. Debt is rising. Cash flow is weak. Exciting story, risky foundation. Lynch's message in this chapter is clear. You don't need to master advanced finance. You need discipline. Look at valuation. Look at growth. Look at debt. Look at cash. That's it. Here's your actionable takeaway. First, never look at P/E without comparing it to growth. Second, favor consistent earnings over unpredictable spikes. Third, avoid excessive debt. Fourth, confirm profits with strong cash flow. Because investing isn't about impressing people with complex analysis. It's about understanding a few critical numbers and using them wisely. And when you do that, you move from guessing to evaluating, from hoping to calculating. That's where smart investing begins. When you buy a stock, you're not just buying numbers. You're buying a story. And in Chapter 14, Rechecking the Story, Peter Lynch delivers one of the most important lessons in long-term investing. Stocks don't go bad overnight. Stories do. Every investment begins with a thesis. Maybe it's rapid store expansion. Maybe it's rising demand for a product. Maybe it's market share growth in an emerging industry. But here's the critical question. Is that story still true? Too many investors buy a stock, feel confident, and then mentally check out. They assume the company will keep executing exactly as planned. They stop paying attention. Lynch never stopped paying attention. He understood that investing isn't buy and forget. It's buy and monitor. Let's say you invested in a regional restaurant chain because it was opening 50 new locations per year, growing earnings at 25%, and expanding into new states. That's your story. Now fast forward a year. New store openings slow to 15 per year. Same-store sales flatten. Margins shrink slightly. Debt increases to fund expansion. Is the story intact? Maybe or maybe not. The key is to investigate, not react emotionally. Lynch emphasizes that when the fundamentals change, your decision should change. But if the fundamentals remain strong and only the stock price fluctuates, you stay patient. Price volatility is noise. Fundamental deterioration is signal. Here's a practical example. Imagine you own a company whose thesis was based on strong earnings growth from a new product line. Over the next few quarters, revenue from that product stalls. Competitors enter the market. Management lowers guidance. That's not just a temporary dip, that's a shift in the narrative. On the other hand, if the entire market drops 20% because of macroeconomic fear, but your company continues reporting strong numbers, the story hasn't changed. The market mood changed, the business didn't. Rechecking the story requires discipline. It means reading quarterly reports, tracking earnings trends, watching debt levels, listening to what management says, and comparing it to what they do. Lynch also warns against falling in love with your stocks. When you become emotionally attached, you defend the company instead of evaluating it. You ignore warning signs. You rationalize poor performance. Investors who refuse to recheck their story often ride declining businesses all the way down. The goal isn't to trade constantly, it's to remain intellectually honest. Ask yourself regularly, is earnings growth still consistent? Is the competitive advantage still strong? Is management executing effectively? Has anything materially changed? If the answers are positive, volatility becomes opportunity. If the answers are negative, it might be time to reassess. Here's the actionable takeaway from Chapter 14. First, always know your original investment thesis. Second, review it quarterly against real performance. Third, separate price swings from business deterioration. Fourth, never let loyalty replace logic. Great investing isn't about predicting the future perfectly. It's about adapting when facts change. Because in the market, the strongest advantage isn't stubbornness, it's awareness. Stocks don't fail randomly. Stories evolve, and the investors who consistently win are the ones who keep rereading the story and aren't afraid to close the book when the ending changes. Before you buy a stock, most investors ask one question: how high can it go? Peter Lynch asks a better question in Chapter 15. What could go wrong? This chapter, the final checklist, is about discipline before action. Because excitement is easy, optimism is natural. But disciplined investing requires friction. It requires slowing down just enough to challenge your own thesis. Lynch believed that before buying any stock, you should run through a mental checklist, not to predict the future perfectly, but to reduce avoidable mistakes. Think of it like pre-flight checks before takeoff. The goal isn't perfection, it's safety and clarity. First on the checklist, what category is this stock? Is it a slow grower, a steady stalwart, a fast grower, a cyclical, a turnaround? Because each type demands different expectations. If you're buying a fast grower, earnings should be expanding rapidly. If growth slows dramatically, that's a warning. If you're buying a cyclical stock, you need to understand where you are in the economic cycle. Clarity of category prevents unrealistic expectations. Second, is the balance sheet strong? How much debt does the company carry? Can it survive a downturn? Companies overloaded with debt don't get second chances in recessions. Strong balance sheets provide flexibility. Weak ones create fragility. Third, is growth sustainable? Where is future expansion coming from? New markets, new products, higher pricing power. If growth depends on one temporary trend, be cautious. Durable growth comes from structural advantages, brand strength, cost leadership, network effects. Fourth, what are the risks? What could break the story? New competitors, regulatory changes, declining demand, technological disruption. Great investors don't ignore risk, they define it. Now here's something powerful. Writing down the checklist forces objectivity. When you're excited about a stock, your brain looks for confirming evidence. You read bullish articles, you ignore criticism. That's human nature. A checklist interrupts that bias. Let's say you're about to invest in a retail company expanding aggressively. You go through your checklist. Category, fast grower. Debt, increasing, but manageable. Growth driver, opening 100 new stores annually. Risk, same-store sales declining slightly. That last line deserves attention. Are new store openings masking weakness in existing locations? Is expansion sustainable? Without a checklist, you might overlook that detail. Lynch's philosophy is simple. The more you think before buying, the less you'll panic after buying. Because once money is invested, emotions take over. Confirmation bias kicks in. Loss aversion clouds judgment. Preparation reduces emotional reactions later. Here's the actionable takeaway from Chapter 15. First, always categorize the stock. Know what you're buying. Second, check the balance sheet, especially debt levels. Third, identify sustainable growth drivers. Fourth, clearly define what could go wrong. Fifth, write it down before you invest. Investing isn't about finding perfect companies. It's about avoiding predictable mistakes. The final checklist doesn't guarantee success, but it dramatically increases your odds. Because in the stock market, the biggest losses rarely come from what you didn't know. They come from what you didn't bother to check. And disciplined investors check every single time. How many stocks should you own? 3, 10, 50, 100? In Chapter 16, Designing a Portfolio, Peter Lynch tackles one of the most misunderstood topics in investing: diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." And that's true. Concentration without understanding is dangerous. But here's where Lynch challenges conventional wisdom. Over-diversification can quietly destroy your returns. Let's start with the extreme. If you put all your money into one stock, your future depends entirely on that company. If you're wrong, the damage is severe. That's not strategy, that's exposure. But now imagine owning 100 different stocks. Can you realistically monitor 100 companies? Read 100 earnings reports? Track 100 balance sheets? Probably not. When your portfolio becomes too large, you dilute your best ideas. Your winners don't move the needle. You end up mirroring the market, but with more effort. Lynch believed in thoughtful diversification, not blind accumulation. He often held dozens of stocks in the Magellan Fund. But here's the key difference. He categorized them. He understood what each one represented: slow growers, stalwarts, fast growers, cyclicals, turnarounds, asset plays. Each had a purpose. Designing a portfolio isn't about random variety. It's about balance. Let's break this down practically. You might hold a few fast growers, companies expanding rapidly with high upside potential. Some stalwarts, stable companies with steady earnings growth. A cyclical stock to benefit when the economy strengthens. Maybe an undervalued asset play where hidden value exists on the balance sheet. That mix creates resilience. Now here's the deeper principle. Conviction should determine position size. If you've done extensive research, understand the business deeply, and believe strongly in the long-term thesis, that stock may deserve a larger allocation. If you're less certain, keep the position smaller. Not every stock should be equal weight. Too many investors treat diversification as a numbers game. They keep adding positions to feel safe, but safety comes from understanding, not quantity. And remember something powerful from earlier chapters. A single 10-bagger can transform your portfolio. But if that 10-bagger represents only 1% of your holdings, its impact is limited. Concentration builds wealth. Diversification protects it. The art is balancing both. Lynch also reminds investors to avoid diversification, expanding into companies or sectors you don't understand just for the sake of spreading risk. If you don't understand biotech, you don't need biotech in your portfolio. Diversification doesn't require ignorance. Here's the actionable takeaway from Chapter 16. First, own enough stocks to reduce catastrophic risk, but not so many you can't track them. Second, categorize your holdings so you understand their roles. Third, size positions based on conviction and research depth. Fourth, focus on quality over quantity. Portfolio design isn't about copying an index. It's about building a structure that matches your knowledge, your risk tolerance, and your long-term goals. Because at the end of the day, investing isn't about how many stocks you own. It's about how well you understand the ones you do. And a well-designed portfolio doesn't just grow wealth. It protects your ability to stay in the game long enough for compounding to work. When should you buy a stock? When should you sell it? Those two questions dominate financial media every day. Someone is predicting the perfect entry point and the perfect exit. In Chapter 17, The Best Time to Buy and Sell, Peter Lynch cuts through the noise with a simple principle. The best time to buy is when you've done your homework and the story makes sense. The best time to sell is when the story changes, not when the price dips, not when the market panics, not when your neighbor gets nervous, when the fundamentals change. Let's start with buying. Most investors wait for the perfect moment. They want the market to feel safe. They want confirmation. They want the stock to prove itself by going up first. But here's the irony. By the time everything feels comfortable, the opportunity is often gone. Lynch believed you buy when your research tells you the company is undervalued relative to its growth, even if the market feels uncertain. Imagine you've studied a company for months, earnings are growing at 20%, debt is low, expansion plans are clear, the stock trades at a reasonable valuation. Then the overall market drops 15% due to macro fears. Nothing about your company's operations has changed. That might be your opportunity. Volatility creates entry points if the story remains intact. Now let's talk about selling, where most mistakes happen. People sell for emotional reasons. They sell because the stock went up and they're afraid of losing gains. They sell because it dropped and they're afraid of losing more. They sell because of headlines, predictions, or short-term fear. Lynch's rule is different. Sell when the reason you bought it no longer exists. If you bought a fast grower because earnings were expanding rapidly, and now growth has slowed permanently, reassess. If you bought a cyclical at the bottom of an economic cycle, and now the cycle is peaking, reassess. If debt balloons unexpectedly, management makes poor capital allocation decisions, or competitive advantages erode, reassess. Notice the pattern? Selling is driven by fundamentals, not feelings. Here's a powerful mindset shift from Lynch. Volatility is not the same as risk. A stock dropping 20% doesn't automatically mean danger, but a company losing its competitive edge absolutely does. Price movement is temporary. Business deterioration can be permanent. Another mistake investors make is selling winners too early. A stock doubles, and they think, I should lock in profits. But if earnings are still compounding and growth prospects remain strong, why interrupt the process? Compounding needs time. Selling a great company just because the price rose can cut off massive long-term gains. Here's the actionable takeaway from Chapter 17. First, buy based on research and valuation, not market mood. Second, view market downturns as potential opportunities, not automatic threats. Third, sell only when fundamentals break or the original thesis fails. Fourth, let strong businesses compound without unnecessary interference. You don't need perfect timing. You need disciplined reasoning. Because in the end, investing success doesn't come from predicting every swing. It comes from knowing why you own something and having the patience to hold it until the story truly changes. The stock has fallen so much it can't possibly go any lower. It's already gone up a lot. I missed it. I'll wait until it comes back to what I paid for. In Chapter 18, the 12 silliest and most dangerous things people say about stock prices. Peter Lynch exposes the phrases that quietly destroy portfolios. Because investing isn't just about numbers, it's about psychology. Let's start with one of the most common myths. If it's down 50%, it's a bargain. A falling stock is not automatically cheap. A stock that drops from $100 to $50 can still go to $10. Price decline alone tells you nothing about value. What matters is earnings, balance sheet strength, competitive position. A broken business doesn't become attractive just because the chart looks painful. Now flip it around. It's already doubled. I missed it. This thinking assumes that past performance limits future potential. But great companies can compound for decades. A stock doubling doesn't mean the story is over. It might mean the business is executing exactly as expected. The real question isn't how much it's gone up. The question is, what does future growth look like? Another dangerous phrase. It'll come back. Investors often refuse to sell a losing stock because they want to get back to even. That's not strategy, that's ego. The market doesn't care what price you paid. If the fundamentals have deteriorated, rising debt, shrinking margins, declining demand, holding and hoping won't fix it. Then there's this one. It's a long-term investment. Sometimes that's true. Sometimes it's an excuse. Calling something long-term doesn't justify ignoring red flags. Long-term investing requires long-term performance, not blind loyalty. Lynch also highlights the illusion of certainty. The market is too high. The economy is about to crash. Interest rates guarantee this stock will fail. Predictions sound intelligent. They feel proactive. But history shows that markets rarely move exactly as expected. Investing based on sweeping forecasts instead of company-specific fundamentals leads to unnecessary fear and missed opportunities. Here's the deeper pattern. These silly statements all have one thing in common. They're driven by emotion, not analysis. Fear of loss, regret of missing out, hope for recovery, desire for certainty. Emotions are natural, but unmanaged emotions are expensive. Let's make it practical. Instead of saying, "It can't go lower," ask, "Has the business fundamentally weakened?" Instead of saying, "I missed it," ask, "Is earnings growth still strong relative to valuation?" Instead of saying, "It'll come back," ask, "Is there evidence the company is recovering?" Lynch's message is simple but powerful. Discipline beats narrative. The market doesn't reward clever phrases. It rewards rational decision-making. Here's the actionable takeaway from Chapter 18. First, separate price movement from business value. Second, avoid anchoring to your purchase price. The market doesn't care. Third, challenge emotional statements with factual questions. Fourth, base decisions on earnings, growth, and balance sheet strength, not hope or fear. In investing, the biggest danger isn't volatility. It's the stories we tell ourselves to justify emotional decisions. And the more you recognize those silly phrases in your own thinking, the stronger and more profitable you become. Most people are fascinated by complexity. Options, futures, short selling, leverage, margin accounts, exotic strategies that promise massive returns in record time. In Chapter 19, Options, Futures, and Shorts, Peter Lynch delivers a grounded warning. If you want to lose money quickly, use leverage. Now that might sound extreme, but Lynch's philosophy has always been rooted in simplicity. Buy strong businesses. Hold them while earnings grow. Let compounding work. Derivatives flip that logic upside down. Let's break this down clearly. When you buy a stock outright, the worst-case scenario is that it goes to zero. Painful, yes, but contained. When you use options, futures, or short selling, your risk profile changes dramatically. Take short selling, for example. When you short a stock, you're betting that the price will fall. But here's the problem. A stock can only drop to zero. That's 100% downside gain for you. But it can rise infinitely. That means your potential loss is unlimited. Unlimited. Now think about leverage. If you borrow money to invest, using margin, you magnify both gains and losses. A 10% decline in a stock might translate into a 30% or 40% hit to your capital, depending on leverage. And if losses exceed a certain level, you face a margin call. You're forced to sell, often at the worst possible time. Leverage removes patience from the equation. And patience is the foundation of long-term investing. Lynch wasn't saying derivatives are evil. He was saying they're unnecessary for most investors. You don't need complexity to build wealth. Let's imagine two investors. Investor A buys shares of a strong, growing company and holds them for 10 years. Earnings compound at 15% annually. The stock price follows over time. Investor B trades options on volatile stocks, chasing quick gains. Some trades win big, others lose big. Stress levels stay high. Capital fluctuates wildly. At the end of 10 years, who is more likely to have built sustainable wealth? The quiet compounding investor. Derivatives often appeal to ego. They feel sophisticated, advanced, strategic. But sophistication doesn't guarantee success. In fact, complexity often increases the chances of error. Lynch believed that individual investors already have an edge. When they focus on businesses they understand, introducing leverage or advanced instruments can erase that advantage. Here's another key insight. Time is your greatest ally in investing. Leverage compresses time. It forces short-term outcomes. Options expire. Futures settle. Margin demands payment. Compounding needs breathing room. When you eliminate time pressure, you reduce emotional decisions. You allow earnings growth to work in your favor. That's powerful. Here's the actionable takeaway from Chapter 19. First, don't use financial instruments you don't fully understand. Second, recognize that leverage magnifies risk faster than reward. Third, understand that unlimited downside is rarely worth limited upside. Fourth, remember that simplicity scales. You don't need to be the smartest trader in the room. You need to be the most disciplined investor. Because wealth in the stock market isn't built by flashing brilliance. It's built by steady compounding, controlled risk, and long-term thinking. And sometimes, the smartest move isn't adding complexity. It's choosing not to. If 50,000 people believe something, does that make it true? That's the provocative question behind Chapter 20. 50,000 Frenchmen can be wrong. Peter Lynch closes the book with a timeless warning about herd mentality. Because in the stock market, popularity often feels like safety. If everyone is buying it, it must be a good investment. If everyone is selling, it must be dangerous. But history tells a different story. Crowds are often most confident at the top and most fearful at the bottom. Think about the dot-com bubble. In the late 1990s, internet stocks could do no wrong. Companies with no profits, sometimes no revenue, were valued in the billions. Analysts justified absurd prices with phrases like new paradigm. It felt unstoppable, until it wasn't. Then flip to market crashes. During major downturns, headlines scream catastrophe. Investors rush to sell. Fear becomes contagious. Rational thinking disappears. And often, those moments of maximum pessimism create the greatest long-term opportunities. Here's the psychological trap. Humans are wired for social proof. If everyone around us agrees on something, it feels correct. It reduces anxiety. Standing alone feels uncomfortable. But investing rewards independent thinking. When a stock becomes universally loved, expectations rise. Valuations stretch. Future growth is already priced in. There's little margin for error. When a stock becomes universally hated, even if the fundamentals remain solid, opportunity can emerge. Lynch isn't saying to automatically buy what's unpopular. He's saying to think independently, to evaluate facts instead of following noise. Let's make it practical. Imagine a company reporting steady earnings growth of 15% annually. Balance sheet is strong. Debt is manageable. But the entire sector falls out of favor because of short-term macro concerns. Media coverage turns negative. Analysts downgrade. Investors panic. Has the business deteriorated? If not, the crowd may be reacting emotionally. Now imagine the opposite scenario. A stock has tripled in a year. Social media celebrates it. Financial news features it daily. Everyone you know owns it. The valuation has expanded far beyond historical norms. Even if the company is good, are expectations now unrealistic? Popularity doesn't equal profitability. Here's the deeper lesson. Markets swing between greed and fear. Your job isn't to predict those swings perfectly. It's to avoid being controlled by them. Independent thinking doesn't mean stubbornly disagreeing with everyone. It means doing your own analysis first and then deciding. Sometimes you'll agree with the crowd. Sometimes you won't. The key is that your decision is based on fundamentals, not pressure. Here's the actionable takeaway from Chapter 20. First, be cautious when a stock becomes universally loved. Second, look carefully when strong companies are temporarily unpopular. Third, base decisions on earnings, growth, and balance sheets, not headlines. Fourth, build the emotional strength to stand apart from the crowd. Because in the stock market, comfort is often expensive. The crowd feels safest right before bubbles burst. The crowd feels most afraid right before recoveries begin. And long-term success belongs to those who can think clearly when others can't. 50,000 people can be wrong. Your advantage is not in following them. It's in thinking for yourself. If you found value in this breakdown and want to become a smarter, more confident investor, make sure you hit that subscribe button right now. Every week, we break down the greatest financial books ever written and turn them into practical strategies you can actually use. Drop a comment below and tell me which chapter hit you the hardest. I read every single one. And if you know someone who needs to hear this, share this video with them. Remember, building wealth isn't about luck. It's about knowledge and discipline. I'll see you in the next one.